It's really a pleasure, a privilege to bring on both a colleague, a friend, Jeff Hirsch from the Stock Traders Almanac. Jeff, thanks so much for joining us.
Great to be with you, Jordan.
Yeah, so Jeff, look, I have to set a stage a little bit. We go back a long time, and for everybody that has never been on a major trading desk in New York City, every single one of them had the Stock Traders Almanac on it, and it was just something everyone looked forward to getting every year. Jeff, you actually are running one of the biggest brands on Wall Street, the Stock Traders Almanac. We see all the time on TV, and we'll get to dig a little bit deeper right now. So let's get into, why the Stock Traders Almanac had this longevity and you're always quoted as there's a couple major trends. So no matter what your stock picking methodology, no matter what you do, you always want to add some seasonality trends and every advantage you could. So maybe you want to just describe the Almanac itself briefly and what it's meant to be.
I mean, it's a trading guide. Yale designed it so that he could follow the market's trends along with his own. It's designed as a calendar, like a desk planner, but it's packed with information, whether it's intraday trading trends or the best and worst 6 months that everyone knows, like Sell in May, or the January barometer that he invented, Santa Claus rally. So you're looking at, indicators, trading strategies, and just the general overall concept of what makes the market tick and how you can, relate that to your own individual portfolio maneuvers, whether you be a pro like yourself or mom and pop running their account out of their kitchen or whatever. So seasonals are very important. We all behave repeatedly, and Almanac tracks the, repetitive, consistent human behaviors of how they move their money around on a daily, monthly, weekly, intraday basis. And that's why we're around for 55 years,
Right. So on that note, the seasonality things, we're going to get into a couple of the major ones that you follow and what they're telling us right now in this market. But I'll also say that there's a quote every day, and I would take my interns and give them old almanacs and say, read them slowly. Don't try to rush them. If you understand what the meaning is behind every one of the quotes in the almanac every year, you're a legend right there. I mean, it really is deep thought. And so I love the quotation part. So one of them, let's just start with, and I'll paraphrase it, but if you don't learn from history, you'll continue to make the same mistake. So I didn't get it right. But the point is, here we are, we had a down January. We have a new president, the first year of the presidential cycle. Tie all this together. No one knows the future, but again, through history, it doesn't rhyme. It doesn't repeat, but it rhymes.
That was Twain, I believe. The down Januaries are important. January barometer is there for a reason. A lot of decisions get made in the month of January. And, as January goes for the S&P, so goes the year. It's not perfect. Nothing is. Even with all the flat years, it's about a 73% accuracy ratio. But we've had the privilege of standing on top of Yale's shoulders, and we've sort of built on the January barometer and created something called the January indicator trifecta. There's always been the first 5 days early warning indicator. That was something that was around before Yale did the Almanac. And then his Santa Claus rally, which is the last 5 trading days of the year, the first of the new year, when you don't get that first 2 of the new year, when you don't get that nice little move, it's a warning sign. His famous quote of Santa Claus should fail to call, bears may come to broad and wall. But we had a positive Santa Claus rally, positive first 5 days, and we had that sort of another COVID-driven end of January sell-off. So 2 out of 3 is not so bad. And we've seen, it would have been great if we had the trifecta of the last 31 times. All 3 were positive. 28 full years were up for about a 17.5% gain on average. 27 of the subsequent 11 months of the 31 years of the 11 months were up for about a 12.5% gain. But 2 for 3, still a pretty decent amount. There's about 11 of those. You see some sizable gains out there. So while we're concerned, with every single down January since 1950, you have a flat year, a new or continuing bear market, or a 10% correction. I think we're probably more in that 10% correction area sometime this year. We've got the Fed booing the market. Post-election years, as you were saying, historically negative. They've gotten a lot better in recent years, and new Democrats, We've got 4 since World War II.
Right.
Kennedy, Carter, Obama, and Clinton. Almost forgot Bill. And only the Carter year all came in with full Democratic controls of Congress. Only the Carter year with the stagflation of the 70s was negative. So just because it's the post-election year doesn't mean it's horrible. Midterm years are still the more difficult year with midterm bottoms in there. But we're still bullish. Worried about some potential weakness seasonally here, end of February into March, also during the worst months.
Right.
But my best case and base case scenarios are still in play. We're looking for something around 4,200, 4,300 S&P, give or take a little bit.
Right. Well, that's pretty positive. And again, we have we could feel the wind behind our back. I know that, frankly, when I met you, it was right around that 97, 98 period that they're talking about in the early segment. And, and while there is some froth, I do believe that there's something even bigger that you've talked about. And I, frankly, I've thought about where we are in the cycle. Yale and yourself have boiled it down to war and peace sometimes. That's simple. And I don't know where we are in the cycle.
That's the big secular pattern. And people, try to confine it to a particular time frame, and it's really driven by events. So this was a pattern. I think you're referring to the old super boom pattern of forecast that I made based upon his work. I made it with the Dow at about 10,000 in May of 2010 for a 500% move for Dow 38,820. Back in 2010, people thought I was a little nuts. Now here we are, 30,000 and change, give or take, depending upon the news flow, and it's pretty much ahead of schedule. And this is based upon these market moves after war and inflation following World War I or World War II, and then his forecast from '76 was following Vietnam, and I just was updating that big chart that he actually drew sort of with a lot of notes by hand back in the day. And we are ahead of schedule. I mean, the forecast was for that move to happen by 2025. I wouldn't be surprised if we get to that 38,000 number before then. So we are ahead of schedule. And I think, the QE and the interest rates are really pushing that. I mean, technology, the other part of that whole equation that we added is that the technological aspect, what I call a culturally enabling paradigm shifting technology, something like the microprocessor, or back in the old days, the combustion engine, the automobile, the airplane, air conditioning, indoor plumbing, if you want to go way back. But these types of things, and we have it now here with, whether it's the cellular technology, the biotech technology, the energy technology, all these things converging to make the world a sort of smaller place. These things that impact everybody individually on the planet collectively. And that's got me, pretty positive down the line. We're going to have our setbacks. We've seen them before, but the market seems to be resilient. And I'm not sure we're ever going to get back to those old historic averages for interest rates. I know they're ticking up a little bit right now, but the world's so huge and there's so much connectivity. I'm not sure we can get back to those old interest rates of yesteryear where, we've got higher, 4, 5, 6% long-term rates. I'm not sure that that's going to happen anytime soon.
Right. And Jeff, the fact is those normal rates you're talking about 5, 6 are actually historically high. Rates have been down in these levels, not zero. But it's pretty remarkable where we've come from in the years since we've met. And, I want to just mention that, I have this quantitative process, which looks at individual companies, but, it's more of, there's a lot of emotions that come into the market. And I like to say it's not the smartest people. And I don't think you'll know better than I don't think Darwin said it was the strongest that survived, but maybe the most flexible and the most adaptive. And that's what our last guest talked about. Maybe I want to share a couple of things along those lines, because I think you hit on it with the technology that's coming.
I mean, adaptation. I mean, first of all, emotions are the most important thing. I've suffered from my own emotions. That's why we have other people trade our ideas now. Okay. But that's the thing you got to keep in check for mostly, whether you're a professional manager or otherwise. You got to stick with your system. Yes, adapt it and change it if need be. But if you start letting your emotions come in there, like happened to a lot of people back in March of last year, you're gonna get burned. and you're best off checking those emotions at the door, going against your intuitions. If you got a stock that goes down, cut that loser short. If you got a stock that's up, don't take those profits. You let that winning stock keep going up. So emotionally, you can't be a trader, you can't be an investor. You've got to put that aside.
So Jeff, before we bring on Dom and Mike, I want to ask you a question myself. I want to kind of end my segment, my thought about what Yale talked about was the truth. And maybe you share the lobe exercise you have in the end of the Almanac, not trying to pretend who we are, but your dad always said the truth matters more than everything else.
I've been talking about that. So as a matter of fact, my son came in the home office the other day telling me, Dad, can I have $100 to buy AMC? When the whole Reddit thing is going on. I'm like, what are you talking about? Where are you hearing about this? Reddit? No. So we go to the page in the Almanac where it says, if you don't profit from your investment mistakes, somebody else will. Performance record. I wrote down the ticker, my son's name, the price, the date. Yeah, it popped up like doubled the next day. And then it went down a few days later below the initial price. So The truth, comes with keeping track of what people tell you, whether it's an advisor, a manager, a newsletter writer, or your friend on the street, or somebody telling you about some stock. You keep track of those stock tips, and you know who's actually got the truth.
Or even yourself, Jeff. People are a legend in their own mind, and they say,
yes,
well, I trade real well. I trade technology real well, and then they take out the records at the end of the year. And it's all about the truth, not about what you hope or think.
And then there's that hubris thing you got to be careful of. The walking on water indicator we used to talk about, where you're your own worst enemy when you're doing very, very well. And you start to get a little cocky and you forget about the truth that brought you there.
Right. Well, see, right now, Jeff, I've shared in a note that I've written recently, the wind is behind our back. Don't take credit for the wind. We know, don't confuse brains with the bull market. You basically have every quote, folks. If you go to the Stock Traders Almanac and just—
What about Galbraith?
Say it again.
John Kenneth Galbraith. Financial Genius is a rising stock market.
There you go. And there's a lot of sweet air right now. A lot of people think perhaps they're a little smarter than they are. But I think that when you break it down to the discipline of knowing who you are as an investor, controlling your emotions like you talked about, and then adding some seasonality to you. But you know what? There's only two things you could do, Jeff. You could either trade and get experience, or you could read books. I think you really need to do both. And when your top 10 books of the year came out, I simply bought every one of them because that's what I thought you needed to do. I still think that I look forward every year to the Almanac coming out. I'm glad you joined us. I'm glad you're prospering in this market. I know you've added not only your insights, but some trading to some other firms you're working with. And hey, Jeff, I just want to thank you for coming on. It's been a long time, years, and I'm very proud of what you do with the Almanac and glad you took the time with us.
Great having me. Thank you, Jordan.